Welcome to the Growth Cap podcast, where we chat with CEOs, investors, and other key industry leaders to uncover insights and strategies for accelerating growth and succeeding in business. I'm your host, RJ Lumba, Managing Partner of Growth Cap. In this episode, we chat with Steve Murray, a Managing Partner at Revolution Growth, which is a late-stage growth fund that invests in private companies around the country. The fund has nearly $1 billion in assets under management and is an integral part to the Revolution platform founded by Steve Case and Ted Leonsis. Steve joined the Revolution Growth team as a partner in 2016, bringing over 25 years of experience with high-growth technology businesses. He joined Revolution from Softbank, where he worked for nearly 20 years with some of the most important technology companies of our generation, including Yahoo, Etrade, GeoCities, Ziff Davis, GSI Commerce, Buzzfeed, Fitbit, Etrade, Kabbage, and many others. In our conversation, you'll hear about how the tech landscape has changed over the years, what Steve looks for in a good investment opportunity, and how the Revolution platform and its Rise of the Rest initiative is having an impact across the country. We hope you enjoy the show. Well, Steve, thanks so much for taking the time. Really appreciate you joining us for this conversation. Maybe what we could do to kick off is just hear a little bit about your background.
Sure. Thanks for having me. So my background is I've been an investor in technology-based businesses for coming on 25 years now, maybe. So I started my career back in the early 90s with Deloitte and was an auditor, and then moved from there to Softbank in the late 90s. So I joined Softbank in 1996, stayed there for 20 years and got to sort of sit on the front row of the commercial development of the internet through things like, I think our first investment was Yahoo, and it went through to GeoCities and Etrade and a whole bunch of others. And as I was leaving my time there, it was Alibaba, right? So there's lots of things in between, and lived through the internet bubble bursting in the late 90s, and then the growth of lots of different forms of internet communication and commerce and the like. So did that, and then 4 years ago I joined Revolution Growth as the managing partner of their growth fund. So that's where I am now.
Fantastic. And we'll head into Revolution, but before we do that, I've seen a lot of interviews with Masa. Obviously, our prior podcast was with Ramsey, who's at Softbank now. But in those early days, back in the 90s, it really seemed like the way to pinpoint or and hone in on a great investment opportunity was really to find out how big the opportunity could turn into. What were some of the things that kind of, when you look back on that experience, that you think was like a key insight you gained into investing?
Yeah, I had the opportunity to learn a lot of stuff over the years and continue to. So one of the things that I learned from Masa and Softbank was the idea around betting into real big macro trends, right? So if you looked at where Softbank did some of its best investments and some of its best work, if you think about at the beginning of the middle to late 90s rather, there was really the growth of the dial-up internet. And so there were a whole bunch of investments that we made around that trend. Then it was broadband internet, higher speed. So it was about video and connectivity and other things. And then it was about the mobile internet and all the different services and activities that both enterprise and consumer that were enabled by that. So certainly from Softbank, I appreciated the really discipline around trying to predict and study and learn from the big macro trends that are happening in the marketplace and trying to get behind those, right? And trying to not be, the timing on these is always hard, but trying to be aggressively investing into those opportunities before they're completely mainstream, right? And so that's really the art and the science of what we try to do when we're doing venture investing.
And over the past few decades, you've probably seen, the how the venture community has evolved, and the number of various investment groups and venture capital firms popping up. How is Revolution growth different than other venture capital and growth equity firms out there?
Yeah, Revolution is a different firm for a couple of different reasons. One is that we have three different pools of capital, one for seed stage investments called the Rise of the Rest Fund, one for earlier stage investments called Revolution Ventures, and then one for growth opportunities called Revolution Growth. So within the Revolution platform, we have three distinct pools of capital managed by three different groups of people that can really address the capital needs of an entrepreneur's journey at the appropriate time and stage of their life. So that's unique. The other thing that's unique about Revolution is some of the things that we can do, which are a little bit different, where we spend our time to try to help our companies. So as an example of that, the firm is physically located in Washington, D.C., and we spend a lot of time and have built some internal and some consulting resources around regulatory and policy related matters. So increasingly, we're finding technology-based companies, particularly those that are disrupting big industries like financial services or healthcare or food stores and the like, are running into and having to deal with proactively and reactively regulatory and policy related matters. So that's an area that we spend a lot of time with our companies with and try to help them navigate those waters proactively.
How is your personal approach to investing? How has that evolved over time, and seeing how the whole landscape, tech environment, tech ecosystem evolve? How's your personal approach evolved alongside?
Yeah, hopefully it's gotten a little bit smarter every year or a little bit more attuned to what's going on. I guess time will be the judge of that. But I think in essence, I've learned to focus on the handful of things on the upfront analysis of a investment opportunity that my experience has suggested is the most important thing for success. So things like what is the quality of the founding team, and particularly the founding CEO or the CEO if it's not the founder. Really focus on that. Why did the person start the business? What is their vision for the business? Does it match with not only my vision for the business, but the firm's vision for the business? If those two are incongruent, that's generally not a good thing. If they're in sync, that usually is helpful. To understand the path that the business has been on. None of these businesses go, at least in my experience, go straight up into the right every year, every day. But to understand how they've dealt with adversity along the way, have they been able to adjust the team and the strategy in a way that has allowed them to be successful? That's also something I focus on. And I'd say thirdly, it's really to try to understand the market into which they operate, both from where could this be 3 to 5 years from now? Because again, we invest in companies, even at the growth stage, that where we're really not investing in the business that exists today, although of course that's what we have to make our assessment on, but what the business can become. So how is the landscape under which they're operating changing? Are the competitive factors getting better or worse? Are the tailwinds, some of the things I talked about earlier with some of the learnings from Softbank around, are the tailwinds in the industry that they're participating in, are they getting stronger or are they starting to wane? Are we at the beginning of that market cycle or the end? So those are the things that that sort of dictate how my personal investing style. Everyone's a little different, and as I said, I've hopefully learned some things along the way, but I'd say those have basically stayed the same over the years, just hopefully gotten a little bit better at them.
And what companies in your portfolio are you most excited about, and why?
Yeah, it's a tough question. We spend a lot of time with our companies, both on the upfront analysis and then once we get involved. So we lead our deals. We actually sit on the board of all of our companies. and we try to help them. So it's hard to, I have 3 sons, so if somebody asked me who's my favorite son, it would be a hard question to answer. So who are my favorites? I mean, some of the ones that I spend the most time with that right now, I really am enjoying. I enjoy all of them. I actually, as crazy it might sound, I even enjoy the ones that aren't going well, because I find I learn a lot, and you learn a lot about the people there, and sometimes those are the most interesting ones to work on. But the ones right now that I'm finding really meaningful and excited about, I'd say one is DraftKings, which is a company I'm going to see later today. They combine sort of 3 things that I'm passionate about, which is sports and media and technology, all in a really interesting game and service for customers. They operate in a very complicated changing regulatory environment, with this the overturning of PASPA, which allows states to offer legalized sports gaming in addition to their daily fantasy sports business. It's a dynamic young CEO and founding team who are really smart and hardworking and committed and really enjoy what they're doing. And so that's a company that I really like working with, and I really am excited about. I'd say another one that I get to spend a fair bit of time on is a very different type of company, is a company called Tempus in Chicago. Tempus is using molecular and clinical data at scale to really bring on precision medicine. So it's a very data-centric business, using massive amounts of data, taking advantage of trends around the decreasing costs of sequencing patients, as well as the decreasing costs and more availability of things like natural language processing capabilities and the like, in order to ingest clinical data and make it searchable and usable. And they're combining those two to really allow for cancer patients initially, but more disease types over time, to have more precise therapeutic solutions to their disease challenges. So that's one that's taking on a really big challenge. It's addressing it through the use of some very, very sophisticated data, taking advantage of positive trends in the marketplace. Again, back to some of the key themes of what we try to invest against. And finally, and not last on that one, is that it really is using is run by an amazingly talented and committed founder and entrepreneur, and Eric Lefkowski, who is really super, super smart, totally committed to the vision and the mission of the business, really believes that this endeavor that he has taken on, and he's created multiple successful companies already, that this one is really going to do wonderful things for the world. So that one is really one we're really proud of at Revolution, and I'm really excited about spending time with. I'd say the third one that comes to mind is one that's sort of in the news for not great reasons all the time these days, which is a company called Convene. So Convene is run by, again, a first-time founder and entrepreneur who's built a really great business around hospitality in the commercial real estate sector. They do meeting space and flexible office space. And when you say flexible office space these days, which is why I mentioned they've been in the news lately, you sort of are getting painted with the WeWork brush, right? So it's really interesting to see this business that has really operated very, very disciplined in a disciplined fashion, has embraced change, has driven great results at its unit level, and has happy customers, and is growing really fast, and really is an interesting and great company to work with a great management team. It's interesting to see how they're dealing with the challenge that got created for them that they really had nothing to do with, which is all the issues around WeWork and the perceptions now that are being painted across any of the players in that industry. So it's great to see Ryan Simonetti, who's the CEO, and his team rallying around this as an opportunity. There's, again, with the back to trends, there's no doubt that there'll be a much higher percentage of commercial real estate in the years to come that will be operated under a flexible work environment. There's no question that is something that enterprises really value and appreciate and want to have. There's no question that the products that folks like Convene are creating are really useful and valuable products. And Convene now looks at this as a short-term blip because the world has decided that for the time being, these are not as desirable models as they were 6 months ago for whatever reason. But Convene really now looks at this as an opportunity to perhaps grow faster, pick up some market share while remaining disciplined, knowing that perhaps for the near term, the equity and debt markets for them may be challenging because of things outside of their control. So again, that's an interesting one to work with. One I think has great future and potential, and one that I get to spend a lot of time with.
Yeah, this whole area of how people work today, and how companies set up their work environments between fixed one location and commuting versus remote versus flexible, I think is very top of mind, especially for both leaders of big companies as well as emerging growth companies. But for it sounds like from what you're seeing, there is this kind of positive trend towards more flexible workspaces. Do you see that growing dramatically in the years to come?
Yeah, every study that I've seen says that right now that number is low single digits, sort of 3, 4, 5% maybe of commercial real estate is operated under that kind of flexible work arrangement. And in the out years, call it 5 to 10 years from now, the estimates I've seen is somewhere between high teens and mid 20s. So I think a huge opportunity for growth. It makes total sense for companies. I think many companies will continue to want to have sort of own and operate, if you will, their HQ. But as more companies are thinking about, do they really want a big a team within their own organization managing facilities and leases and buying equipment and keeping the internet running for some of the satellite-like offices or secondary facilities where maybe they need 20 people this year and that might grow to 30 next year. The notion of, particularly think about in the world that we live in now, companies signing 10-year leases for a fixed amount of space when you really don't know what your workforce is going to be, where they're going to be, how often they're going to be in the office, how much space they need. It really doesn't make any sense. And I think solutions like the one Convene provides are much more amenable to not just startups, which is I think the area that WeWork really had succeeded well in, but really enterprises, which is really where Convene has always focused.
You'd mentioned that Ryan was a first-time founder, and it's sometimes more difficult to gauge probability of success with new founders, although that's the predominant type of founder when you're in the venture world. But I guess what are some of the key traits that you think backable first-time founders have?
Well, they all have the successful ones, and I guess sometimes even the unsuccessful ones. But you really look for whether they have a firm point of view, right? Their point of view about how they want to develop the organization? Have they developed the organization? Have they been able to attract and retain quality people on their executive team other than maybe the founders? That is sometimes, particularly for us that are looking at the growth stage businesses, that's a real test because oftentimes the folks that, as I say, the folks that got you there are not the folks that are going to get you to where you need to be. They might have been the right team to get you from 0 to 10 or from 10 to 20, but they very well may not be the right team. That doesn't mean they have to go away, but the team needs to be augmented and added to in order to get to 50 or 100 or $200 million of revenue. So a big part of it is the point of view on the market, the point of view on the team, their ability to develop the team, and how they've been able to plan. That's the other thing for me in particular I focus a lot on, which is it's very hard, particularly in the growth stage, to be the CEO and be effective and be successful unless you can adequately plan. And therefore, how are you getting information? How have you set up the discipline within the organization to encourage accurate planning? Because the risks of poor planning go up over time because you're deploying bigger resources across the organization with less immediate knowledge of exactly what's happening as it might have been when the company was much smaller. So those are the things that I really like to focus on, frankly, whether it's a first-time CEO or a multi-time CEO, but it's really those things where I spend a lot of time on the front end.
How's the overall, the macro picture changed, and do you have any insights on kind of where you think kind of capital for private companies, how is it moving, where is it moving towards, or is it just more of a gradual evolution?
Yeah, no, I mean, there's no question that there's a few, I think, undeniable facts. One is that the amount of time that companies are staying private has extended, right? So therefore, by definition, the amount of money that they're raising as private companies has increased. So that has created opportunities at the later end of what used to be a private company's life, which is now maybe the middle of their company's life. So what we find is that the definition, and I'm sure you have this with other folks that you've talked to, the definition of what is a growth stage company means very different things to very, very different people, entrepreneurs, investors, LPs, and everybody else. So we look at a growth stage company as one that has product market fit, that maybe has $20 or $30 million of revenue, that is growing fast, where the entrepreneurs and the management team and the investors are all excited about the next phase of growth and want to put some fuel on the fire to grow even faster. That's what we that's what we plot out and where we participate. But there's obviously 2, sometimes 3 rounds later than that. Oftentimes these days, those companies may still be private companies. And those are where Softbank is putting in, hundreds of millions of dollars, and crossover firms that are more well known as mutual funds, things like Fidelity and Wellington and T. Rowe Price, might be investing. And if you think about it versus several years ago or many years ago, where those companies would have been public companies, and it feels on some level appropriate for those types of firms with those types of capital bases to invest in that stage, where folks like us that are private equity investors and really venture growth investors need to remain disciplined, is that we need to make sure that we're investing in companies that still have plenty of growth left in them, and that really are hitting the knee of their curve on growth, and that they're not too far up the scale, if you will, where what is left in terms of a return potential is not what we've set out to do, right? So we have to be careful that we're making sure we don't go too early, but frankly also too late, because there's still a lot of private investment dollars that get invested in these businesses well past where we would call it for us, the right entry point.
The fact that there's, new funds popping up, just more capital, it's seemingly more capital available there. You don't feel that there's necessarily an oversupply of capital for the number of, private company opportunities out there.
Yeah, I don't, I've heard that a lot and I've read that a lot. I can tell you about, what we see every day, which is, and this has been consistent since I've been doing this, which is the best opportunities seem to always be competitive with a handful of folks. And, companies that are really struggling, that don't seem to have direction, seem to eventually go away. Now, there's probably, I would say, there's clearly more capital chasing after some of these deals than there used to be, which probably has led to, certainly in many instances, prices beyond what we would pay. So I would say that's probably the most common reason for us to walk away from an opportunity that we otherwise like, is price. And that's more common than it was years ago, and that probably has to do with the number of funds out there, chasing those opportunities. But it's always been a competitive environment. Great entrepreneurs always have choices as to who they want to work with. I think the smartest ones always choose their lead in their next round based on a balance of things, including price and terms, but it's also other things. What else can what can they do for the company? Will they be good board members? Will they stay with the company through thick and thin? What is the portfolio that they have put together, and can those portfolio companies be helpful to theirs? There's a lot of different factors that go into it, but there's no question that there's been some price appreciation in a number of the best opportunities, or a number of what look like the best opportunities, where, and we saw this a little bit in the late 90s, where, companies in some instances are being priced in the private round as if they're going to have nearly perfect execution for the next 2 years, which is very hard.
As we kind of wind down the conversation here, maybe one thing we could expand on that you had mentioned earlier is the rise of the REST fund. It seems like that's, making waves. It's, certainly received some attention out in the media, and it sounds like it's set up to have some tremendous impact. So we'd love to hear a little bit more about the rise of the REST philosophy.
Sure. So the rise of the REST is a fund, but it's also a platform. There's well documented bus tours that Steve Case has been on for a number of years, and they do several of them a year and go to a bunch of cities and really rally both public and private constituents in the various cities and try to inspire them to build an entrepreneurial ecosystem within their communities and the benefits thereof. So the basis of Rise of the Rest is the notion that entrepreneurial instincts and ideas and people are reasonably evenly distributed, but capital is not, right? So most of the capital has been invested in venture stage businesses in Northern California, some in New York and some in Boston, but those three places get a lot of the attention and money. And the Rise of the Rest thesis is that should not be where 70 or 80%, that's not where 70 or 80% of the good ideas come from. There's no question there's great ideas and great schools and great reasons for those areas to be successful. But there's also lots of other places across the country where there can and should and frankly needs to be technology-based entrepreneurship, and that there's great benefits to those communities to make that happen. So the real, I think, driving force behind the Rise of the Rest is to be the catalyst for that change. And some of that change has happened and is happening in places like Nashville and Columbus and the like. Some of it, frankly, has already happened in places like Chicago and Atlanta and others where, they now have thriving ecosystems and incubators and accelerator programs and investors that go there regularly, and some that are now based there, and bigger companies and strategic companies that think about those areas as areas that they need to pay attention to. So that's really what Rise of the Rest is all about and the mission that they're on.
That's fantastic. And just out of personal curiosity, I noticed you were a competitive swimmer. In your younger days. It's for those in the audience that have kids. I actually have this conversation with some of my friends about how sports can really impact kids in particular, and even into the older years, obviously college and even post college. But how did swimming kind of impact you overall? I'm sure it's played a role in some way.
Yeah, we could do another separate 45-minute conversation about kids and sports and the benefits and frankly some of the pitfalls of that. I have 3 teenage sons, one who's in college and 2 that are in high school, and they're all very active athletically. And I've had the opportunity to coach some of their teams as they've grown up. But for me, sports was a big part of my life growing up. I think the competitive side of sports is great. I think the fact that sports is sort of a meritocracy was great. You know, you don't get to win the race because you grew up on one side of the tracks or the other. You get to win the race because you either have talent or you have hard work, or it's usually some combination of both. I think swimming in particular, that was one of the sports that I did. It happened to be the one that I did in college, but swimming it tends to be a little bit more individual driven, although there were certainly some team aspects to it. My favorite part of swimming was always being in the relays. The other sports that I did, basketball and soccer, were much more team driven. My kids play ice hockey and lacrosse, and they're actually sailors. But the ice hockey in particular, which is a team sport that I really enjoy. Everybody on the team has to contribute. You know, it's not just the 5 kids that start out that have to contribute. For the team to win, the first line, second line, and the third line all have to play, and they all have to play their role, and they all have to contribute and work hard and know what there needs to be accomplished from them. So I think there's great value to be driven from sports. It's been a big part of my life. I continue to like sports and watch a lot of sports, and as I said, really been able to be blessed, participate, you know, as a coach a little bit with my kids as well. So sports has been a big part of my life, and I really enjoy them.
Great. Well, Steve, thank you so much for taking the time. I know our audience will find this very insightful.
Thanks very much. Thanks for having me. I appreciate you doing it.